Wouldn't your life have been nice if you had inherited your own banking system? One that you could use not just to store your wealth, but also to finance literally everything you've ever needed in your lifetime? What if this was something that you could do for your kids or your grandkids? If you're a parent or a grandparent, this episode is for you. Hey, if you're new here, my name is Kristyn. I'm an authorized infinite banking practitioner. I help Canadian families and business owners reclaim control over their money, create financial peace, and live the abundant lives that they were meant to live by keeping more of their hard-earned dollars working for them. So today I'm here with my friend and mentor, George Roth. George is a fellow infinite banking practitioner and co-author of the book Child Millionaire. He has been an amazing mentor to me throughout my infinite banking journey and genuinely practices what he preaches. So good to have you here. So I really just wanted to talk about the Child Millionaire strategy that you wrote about in the book with Liz and Cole. So how did you get into infinite banking to start with?
Okay, good question. Well, ultimately by accident. So I was attending a real estate investors networking event, as a lot of people do. And it just so happened at this event, there was an individual who was given some time to talk about becoming your own banker, which was a brand new concept. I'd never heard of it. I didn't even know what he was talking about. So of course it was based on Nelson Nash's book, Becoming Your Own Banker, and unlocking the infinite banking concept. So we had about half an hour to talk about it, which is not really enough if it's something that's brand new to you, but it was enough to pique my interest. And they were offering a seminar that my wife and I attended. And once we understood the concept, how it worked, I was obviously a little skeptical and cynical in the beginning, as most people are, because it is something new. And I'm an engineer by trade, so I like to analyze things. I don't take things at their face value. But we looked into it, checked out the numbers, and it all made sense. And we started becoming practitioners as clients. So we initially started as clients, my wife and I. And I was licensed already in the insurance industry at that point in time, just kind of doing it part-time to learn. I just wanted to educate myself. And once we understood how this worked, it's one of those things, once you hear it, you can't unhear it. Once you see it, you can't unsee it. So, and we just had to move forward, and it was too good not to share, right? So I felt compelled to help other people understand the concept. So I joined an agency, the same people that put on the seminar, and the rest is history. And that was 16 years ago. So we have been practicing it in our lives with our kids and our grandkids. So we have 15 policies now in our family, and I've been teaching it ever since as well. So as you know, we are authorized practitioners with Nelson Nash Institute. So we are qualified and authorized to help others learn this concept and learn it in the right way and do it the right way. So that's what I've been doing, and that's kind of how I got started, which is a long-winded way of saying I stumbled upon it, and once I learned, I couldn't go back.
You touched on so many things there that I kind of want to come back to. The
Sure.
first one, I think it's so interesting that you started it was a real estate meeting. And so this was all real estate investors. So it just shows the infinite number of ways that we can use this concept in our lives, because you literally learned about it through real estate investing. Did you start with real estate investing, or was that, did you move more into using family policies first?
Yeah, you mean as how do we implement it? How do we use it?
Yeah.
Yeah, so we were in real estate before. So we had done some, a buy and hold. We did a flip, a couple other things in real estate. So we were doing that, and we were learning about real estate. We'd taken some courses through the Rich Dad Poor Dad. So that's what we were doing, right? We were doing the typical things, right? So P's, mutual funds, real estate. And then we learned this concept and learned that there was a better way, less risk, more flexibility, more liquidity, just a better option, better place to put our money. As far as using it, so initially, one of the first ways that we used our system was we bought a business. So there was an opportunity presented to us to buy a business for 13 cents on the dollar. So because we had capital available and we were able to take advantage of that opportunity, we did, right? So we bought a business, then we ended up buying another business. Subsequently, we sold those businesses. That was one of the ways initially that we used our system. Yeah, for sure.
Nice. So how do you translate from that into the Child Millionaire strategy? So you started there. Your kids would have been probably teenagers at that point ish.
Yeah. So 19 and 22, I want to say our kids were at that time.
Okay.
So our first two policies were for our kids. So that's how we started with them. So really, we've been practicing Child Millionaire concept for 16 years. It's from the beginning. We just saw the advantages right away. And because they were young adults, it just seemed like the best way to start. Get them started. Now, we as owners and payers have control. So that's also important, right? So as parents and grandparents, we are the owners, we have control, we decide how, when, and if we're going to use those policies. But we always have the ability to transfer ownership to that next generation if and when we choose. So that's part of this overall strategy as well. So we're doing this for our kids and our grandkids, not necessarily getting insurance on them, we're doing it for them. Because if they're too young, they can't do it themselves. Now, in this case, our kids could have done it themselves, but we chose to be the owners and get policies for them. And that's how we started.
I love that you started them later on in life, because so many people I talk to and we start talking about the Child Millionaire, they think, oh, I didn't start that when they were a baby, so it's too late. They're in their teenage years. I know that's not true. I've started my kids' policies too, and they were in their late teens when we started theirs, like 18, 19. So when you're talking about starting, does it matter if you start later on? What would you
No.
say the biggest difference is there?
Yeah, the older we are, the cost of insurance goes up. However, for the purposes of infinite banking and to be using the cash value, the equity that we're building up in the policies, age doesn't matter. So life insurance companies use a 100-year lifespan. So the growth is on an exponential curve, and the cash must equal the death benefit at age 100. So the closer we are to 100, the steeper that curve. The further away we are from 100, young kids, babies, the slope is more gradual, right? Because there's a longer time frame. So it really doesn't matter where we start. It's going to grow faster the older we are. It's going to grow slower the younger we are. But the advantage of younger is that we have more time. So there's no bad time. There's no wrong time. Any time is good. And then also what's important is that we come back to the purpose. What is the purpose? What are we trying to achieve? What is our goal? So with teenagers and young adults, we just want to get them started. They can take over when the time is right, if we choose. And now they have something for themselves. And then they have something for their next generation as well. If we do it for the young ones, where they can't even do it for themselves, we have longer time. Now, when they start getting into their teens and early 20s, the time when people need money, right, for education, cars, houses, whatever it is that what you want to do, the money will be there available to them. Whereas if you're starting later, well, then they just have to, their purpose is going to be something different. Maybe it's not education. Maybe it's going to be they're going to save up for their first house, or they're going to buy a car or go on a vacation, whatever the case may be. So when we start doesn't matter. Why we do it is what's more important.
So let's talk for a minute about the Child Millionaire strategy kind of on its own as part of the infinite banking concept. But what exactly is the Child Millionaire concept?
Yeah, it's really about getting kids started, right? So there's kind of five main reasons why it makes sense to buy insurance for children. And it's important to distinguish for them. We're doing this for them, for their benefit, and for the benefit of the generations that follow. So as we know, with the infinite banking concept and participating whole life insurance, it is an excellent place to create, store, preserve, protect, and use our wealth. So for children starting young, where they have longer time to grow and use it, it's an excellent place to save for their future. You're also giving them options. So for instance, contrast this concept with the RESP, Registered Education Savings Plan. So it's a government program designed to help parents and grandparents save money for their children's post-secondary education. And there's some tax advantages that the government gives us, and they also give grants. So it's a maximum of $7,200 for a lifetime, and it has to be used at a certain time. You can only contribute a certain amount. So there's a lot of rules around how it can be set up and how it can be used. So your child has to go to university. It has to be at an accredited university that the government approves for them to even use it. And you're investing with risk. So you're hoping that money does grow over time. It may not. So best case scenario, you save up, the money grows, your child goes to university, and the money gets used for post-secondary education. Well, now that money's gone. Can never be used again. The opportunity is lost for that money to be used again. So you've met the purpose of that money, but you've only given that money one job. With the infinite banking concept and the Child Millionaire concept, we are giving our children options. They can use the money for their post-secondary, yes, but they don't have to. If they don't go to school, that's okay. It doesn't matter. There's no penalties, there's no hits, there's no restrictions. Maybe they want to start a business. Maybe they want to travel. Maybe they want to buy their first car. So we're giving them options. Same dollars, same purpose, but now they have options. And that money can be used over and over and over and over again for multiple uses. So it's a big, big difference on how we put our dollars to work and benefit our children. Plus, there's going to be a death benefit that's going to go to the next generation tax-free. So not only are you benefiting you, so if you are the owner and the payer and have control, you can benefit yourself, you can benefit your child and or your grandchild while they're alive, and you're going to benefit the next generation with the tax-free death benefit. So not only can we use it while we're alive, our kids and our grandkids can use it, it's going to benefit the entire legacy and the family legacy because money is being built up and snowballing and gets passed on to the next generation. So we're making every generation better, 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 better. And on top of all that, we have to teach our children and our grandchildren the stewardship of that wealth. So it's so important that they have to keep the wealth growing and expanding for the next generation.
It's my favorite part about the concept.
Yeah. So there's a lot of good reasons why to use this concept versus any other. Yeah, those are kind of the highlights.
Yeah, I was going to say my favorite part of the Child Millionaire strategy as a parent is teaching my kids, like you said, how to steward it. How it's not just giving them this lump of money that they're going to use for a specific thing. Even if you were saving up and you have to use this for a business. Imagine if your parents said that. You have to take this money and have to go into the family business. The idea is to give your kids the choice. They have this family banking system where they have the choices to be able to grow it. They have the choices of how they're going to use it. And they can rinse and reuse it over and over and over again. It's like if somebody gave you a line of credit early on in life with an increasing limit every single day that you can reuse through your whole life. Imagine how much it would change your life if you had access to that way back when. Even as teenagers, they can use it for car loans or small business loans, things like that.
Yeah, for sure. And I mean, it's a good analogy just to talk about it like a line of credit. However, typically a line of credit is based on you're using equity in something like property. Well, there's no guarantees that property is going to go up, right? And you're not guaranteeing that collateral. With whole life insurance, the lender, who is the insurance company, is actually guaranteeing the collateral that you are leveraging to use while you're alive. Nowhere else does this happen. Yes, the line of credit and the balance is growing, 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 growing. So you have more and more that you have available to use. You can replenish it and reuse it again. So that it's similar in that sense. However, it's not guaranteed that that can always go up, because what if the equity
with an
that you're
outside
using as
source.
collateral doesn't go up? Yeah, exactly.
Yeah.
So it's even better than that. It's a way to help people understand the concept, but this concept is way better than anything else.
Yeah. And the value can't be taken away. It can only go up. That's your contract. Like it's when you see it, like you said, you can't unsee it. It's so good that I mean, first questions I always get is how can this be true and how can this be legal? You know?
Yeah. And if it's so good, why isn't everyone doing it? And if it's so good, why haven't I heard about it
Yeah.
sooner? Well, we know what we know. We don't know what we don't know, right? So, if I didn't stumble upon this concept by accident, I wouldn't have known either, right? So, unless someone tells you about it, you're not going to know. And not to mention that, the government, the banks, none of them want you to know this concept because it doesn't benefit them, right? So, those are
Yeah.
good
You have to look
questions.
at where
They're
you're.
valid questions, but yeah,
Yeah. I always tell people you have to look at who you're getting advice from and how they're making their money. Because if your financial advisor, if all they sell is stocks, and I'll argue even insurance, because a lot of insurance brokers push the seg funds and they push the RSPs and they push all of these things and have no idea how par whole life can work for someone to build their wealth and keep it safe.
yeah.
I've seen a lot of those brokers too, but yeah, just go back to how they're getting their information, where they're making their money, and chances are it's not that they're a bad person, they just don't know.
That's right. That's right. And it doesn't have to be an or, right? Like this is an and asset. So it's an and. Everything is an and. You can do this and you can do something else. You can use this to do something else. So it's all about and options, choices, and control. You always have control. You dictate the terms. So just a couple more points. So we talk about, teens versus younger kids. Is there a bad time, good time? Does it matter how old they are? Another huge part of this that often gets overlooked is our ability to guarantee the insurability of our kids, regardless of their age, whether they're teenagers or whether they're newborns. Heaven forbid something happens to their health, or it doesn't have to be about their health. It can be about their lifestyle. If they make some bad choices along the way, they can become uninsurable. And then they don't even have a choice. They don't have an option to get life insurance, potentially. So if we can lock that insurability in place when they're young, when they're healthy, it can never be taken away. And then we lock in their ability to get more insurance even in the future, regardless of health, regardless of lifestyle, right? So that's another important aspect. So any age that we can do that is a good thing.
And it's so inexpensive to start. If you start someone, the younger they are, of course, the less costly it is, just because their payments are spread out for the rest of their life. But it just to guarantee that insurability, like we can start so small with these and we can keep it so affordable that the benefits that this child's going to see for the rest of their life, just to lock that in, is huge.
That's an excellent point. I mean, we're locking in the price point, right? Young, young is the best. And young teenagers, early 20s, that's still young. 20s, 30s, that's still young. You're locking in, certainly in the life insurance world. So you're locking in that price point. So now you know that insurance, that cost of insurance will never go up for their entire life. Think about that. So where else does the cost never go up for a lifetime? And if you're locking in it at a low point, it stays low for the rest of their life. And they're paying for weaker dollars into the future as well. And the value is guaranteed to go up. So the cost stays the same, the value goes up. Nowhere else does that happen. So it's a great hedge against inflation. There's tax advantages that we haven't even mentioned so far. The list of advantages is very, very long. And there's really no disadvantage, really. Yes, it does take some time. Yes, there is some commitment and discipline, but anything that's worthwhile does take time. It does take discipline. So I don't even see that as a bad thing.
So, what would you say has been, I'll say, in the child realm, what's been your favorite cases? Like your favorite, do you have, can you think of any stories that were like any success stories or something that, the clients were really happy that they put this in place when they did?
Well, I haven't met a client yet that's not happy once they have it in place, especially for their kids. I mean, sometimes it's hard for people to wrap their brains around life insurance for a child. So that's why we have to think differently. We're thinking think of it as you're setting this up for them and their future and their kids' future. You're not doing it even though that protection is incredibly good and it's there for the rest of their life and it will pay. The main purpose is to get them set up so that they can use it while they're alive and then pass on that legacy. So it's really important to change the way we think about it. I don't know if there's any specific case that comes to mind, but certainly in my own family. So we have 3 grandchildren. So we as grandparents have a policy for each of our grandchildren, and their parents have a policy on them as well. So 3 of our grandchildren have 2 policies. So they are going to be set for life. This is incredible. So as a grandparent, how can there be anything more powerful and more satisfying than to know that you are setting your grandchildren up for success? And it's not an if, it's a when. And then the important thing is that they understand what they have and that they use it correctly. So that comes over time, right? As they grow older, we want to slowly and consistently educate them on what it is that they have and how they can use it and how they can keep it going. So to me, that's incredible. I mean, I can't think of anything more satisfying as a grandparent to know that we have that for our grandchildren.
And you touched on it earlier, but you mentioned, kind of alluded to it again just now, talking about how the parents or the grandparents are the owners of these policies. It's not the kids. And it's so important that we, one, educate our kids. We want them to know that they're going to be able to steward this well before we hand over the ownership. And I'm speaking as someone, I tell the story all the time. But if someone had handed me a life insurance policy that had a $20,000 cash value, and I could either cash it in and get $20,000, or I could pay a couple $1,000s a year to keep it in force, guess what I would have chosen? Right? I would have cashed it in because I would not have seen the value. So,
I'm sure there are many examples of people who did that.
exactly. And I can say now, that's why it's so important to me and why it's so valuable to me that I can teach my kids about how this works, because I would not have had a clue what it is, because that's not financial education. We don't get any financial education in Canada, but that's not something that would have ever even crossed my mind. I wouldn't have even, at that point, you're not seeing illustrations. All you're seeing is the bill and the worth, and I would cash it in.
Yeah.
So it's just so important. And I love that there's not a certain age. Like, you don't have to hand it over to your kids the minute they turn 18. Some kids are ready at 18. Some are ready when they're 40,
That's right.
And you can choose when to hand it over.
Excellent point. And to that point, if I'm looking at handing over control to a child or a grandchild and they want to cash it in, well, guess what? They're not getting it, right? Until they understand what they have and how to use it and what to do, they're not going to get it, right? And we have that ability. We decide, right?
Yeah, exactly. With my kids, we set them up so they get set up, around 18, and I stay the owner. I'm staying in control. When they take out policy loans, I'm walking them through how to take out their loans. How to repay their loans is the more important part. What they're going to use them for, how they're going to pay it back. And it's to the point now where my oldest son, he's almost 20. He comes to me, every couple of months. Hey, mom, can we look at my policy? What's it looking at? What does my cash value look like?
Yeah.
Because he
Yeah.
genuinely wants to know. He knows the more he puts into it, and he's to the point where he's ready to start growing it now and increasing the amount that he can put into his policy, which is amazing after only doing this for like 2 years.
So just to kind of go back to some examples, you asked me the question about examples. To add to that, so a couple of examples just even in our family again. So our kids, we started when they were, late teens, early 20s. And then they got their own policies as well. So in the example of our daughter, so she went to university and worked part-time and then got student loans to help her get through university. And then when it came time to pay those student loans, she was able to take some money from her policies that she owned and paid for, pay down that student debt. And then instead of making payments to the government, she then made payments back into her policies. So her purpose didn't change, but the benefit was much larger, and how she did it was different. So, and with student loans, you've got 6 months after graduation before you have to start making payments and they start charging you interest. So in essence, you've got like 4.5 years of free money. So, working part-time, student loans, got herself through school, and then used her policies to help pay off that student debt and benefit herself. Meanwhile, her policies are still growing. While she's doing all this, she's going to have something at the end of the day too. She's not going to have an empty RESP. She's going to have a policy that's continuing to grow. And there's going to be a death benefit for her son. So it just makes so much sense. It's just a better way of using your money. You don't have to use more money. You don't have to change your cash flow. You don't have to change your objectives. You just are going to do it in a different way that's going to benefit you and not benefit someone else. So when people understand that and they see that, it pretty much becomes a no-brainer. I mean, the key is the understanding part.
Can you explain, just for people, because this is a question that I get a lot, can you just explain how paying back a loan to herself inside of her system benefits her system, how that helps grow the system?
Yeah, so the loan itself is not necessarily going to grow the system faster. So using it is not going to make it grow faster. But what you get to do is you get to use your money in multiple places, and you get to reuse it over and over and over. And a lot of people get hung up on the idea that you're borrowing your own money. That is not the case. That is not how it works. You are borrowing money from the insurance company using your policy as collateral. So you're leveraging. And this is what the wealthy do. Talk to Robert Kiyosaki, Rich Dad, Poor Dad. He talks about this all the time. Leverage, because of the tax advantages primarily. But we're leveraging, and because we're leveraging, our cash is continuing to stay and grow. So the full amount is growing. And as you replace what you've used, along with the growth, you're now going to have more to use in the future. And more and more and more is going to continue to grow. Now, you can always put more in than you have to as well. So this is a way to grow it faster, is by putting in extra, even though you don't have to. Because any additional dollar you put into it is going to help with that compounding growth. Because you're just making that policy bigger and bigger and bigger. As with anything, the more you put in, the more you're going to get out.
And that's where the infinite banking concept really comes in, because that's what Nelson taught, is you have to be an honest banker, rule number one. And so you're going to pay yourself back the interest that you would have paid to that third party, even though the
Right.
insurance company is not charging you that same amount of interest. So what do you do with the extra interest? That's your extra that you talked about that goes into your policy that grows your death benefit, which in turn makes your cash value have to climb to reach it. And
Yeah.
so it's
And I
returned
mean,
to you almost dollar for dollar.
yeah, absolutely. And if
Yeah.
you think about that, just think about that for a second. So instead of making payments to someone else, so where you're giving principal and interest to a bank or to the government, you're benefiting them, right? And only them. Whereas if you can redirect those payments back into a system that you own and control, you will benefit, right? Not them. So any interest that you pay to the insurance company indirectly is going to benefit you because we earn dividends based on the profits of that company because we are the shareholders of that company. This is another aspect that is incredibly powerful that is often overlooked. We are the shareholders of the company when it's a mutually owned company. So we benefit from the profits. So anything that goes into that company is going to indirectly benefit us instead of someone else. So why wouldn't you do it that way?
Yeah, it's so powerful. And another thing, just kind of touching on the same line of thought, I have this conversation a lot with people that are, approaching retirement, or maybe they're in like their 60s and they have policies and they say, "Oh, but I just want this for the death benefit. I don't need I don't need to use the cash value. I don't need loans." And I say, "Well, what about your kids or your grandkids? If you're loaning your grandkids $10,000 to buy a car and they're paying it back with interest, the interest is coming back to them anyway. It's going to
That's right.
benefit them that much more in the future because it's coming back to them eventually in the form of a death benefit, tax free. Why wouldn't you want to use your family system? It's
Exactly.
it's a no-brainer. Once you see it, you can't unsee it.
Yeah. Yeah. Absolutely correct. I mean, the family system is important, right? So, we've talked about the multi generations, right? So we've got the grandparents, the parents, the grandkids. We can, for instance, so my wife and I buy a policy on one of our grandchildren. Well, we are the owners and the payers, and we can use that cash if we choose. We will in turn transfer ownership to our kids, the parents. They can use it when they're alive because they will be the owners and the payers. And then when they're ready, they can transfer it down to the grandchildren. So it can be used by 3 generations, and it's going to benefit all 3 generations, almost all at the same time, right? So, I mean, I like to talk about the Rockefellers and the Vanderbilts. So they were two of the richest families in America in the early 1900s. Well, the Rockefellers are still wealthy. The Vanderbilts are not. There's not a millionaire within the Vanderbilt family. So if you don't teach that stewardship, if you don't pass on that wealth and grow that wealth and continue to grow it from generation to generation, it can be squandered. So the Rockefellers used whole life insurance and family trusts to make sure that their family wealth continued to grow every generation. And every generation had to contribute to that growth. And they had to prove that they were going to do that and could do that. So if you don't do that, the money can be lost. So that's where the stewardship comes in, but also the using life insurance just grows that bigger and bigger and bigger. The snowball gets so large over time because of that tax-free death benefit that keeps getting bigger and bigger as well.
And we talk about using policy loans and using it during your lifetime, but the death benefit is a bonus at the end that your cash value will, when you pass away, your cash value does not equal your death benefit yet. There's always going to be a difference, and that goes to your beneficiaries tax free. So even if you're using it, and this was my like aha moment when I found out about it, was wait, this is life insurance like for while you're alive, like you can use it while you're alive and you can keep accessing this money. Like I can, and there's still going to be money there to go to my kids and grandkids. That's
Mm-hmm.
amazing.
Mm-hmm. Yeah, it is amazing. With guarantees,
Yeah.
right? Yeah, yeah, it's incredible. One way to think of it too is, for instance, if you use the cash and don't repay it, which you don't have to, ideally you want to, right? And we teach people that, the best way to do it. But if you choose not to, especially if you're in retirement, right? This can become a tax-free retirement income, and you will be leaving a death benefit. But think of it as an advance on that death benefit. So if you use that cash and don't pay it back, it's an advance on the death benefit that you get to use in a tax advantaged way. And there's still going to be a death benefit that's going to go to the next generation tax free. So again, it's an and. You get to do all of these things.
Yeah, it really is a no-brainer once you see it and you understand how it works. It just keeps getting better the more you use it. And I mean, we can
Mm-hmm.
both attest, like we have multiple policies between us, obviously. Yeah, and just the ways that we keep using it. And I know in my family, we just keep finding more and more ways to use our policies and more ways to keep it working for our
Yeah.
advantage.
Yeah. Yeah.
So, is there anything else that you would like to add that you would like people to know?
I think the main thing when we are parents and grandparents and we're thinking of how can we best take care of our children and our grandchildren, what is the greatest gift that we could ever give them? The greatest gift that we can ever give them is the golden goose. So instead of giving them golden eggs along the way, whether it's gifts, whether you help them pay for things, you contribute to their wedding, et cetera, et cetera, et cetera, all the things that we do with our for our kids and grandkids. What if we just give them the golden goose and teach them how to take care of that golden goose that's going to keep laying golden eggs for the rest of their life? Why wouldn't we do that? I mean, it's just the best gift that we could ever give our kids and grandkids.
I love that analogy, the golden goose and the eggs. Love it because that perfectly summarizes it.
It really
All
does.
right. Thanks so
It's
much,
just
George. If you'd like to learn more about the Child Millionaire strategy, you can purchase the book on Amazon and I'll link it in the description. Thanks so much for watching, guys. If you found this episode helpful, please give it a like and hit subscribe. When you're ready to take the next step, click the link in the description to access my free resources and to book a call to start. Your future self will thank you. Until next time, live free.